Hi, everyone. Welcome back to the Mortgage Heroes Weekly Podcast. I'm Andy.
I'm Brian.
And I'm Will.
And today we are going to talk about 4 new topics in real estate. And right up the top, guys, it's the VA. We've been talking about the VA a lot, of course, because of the whole NAR lawsuit and whether VA buyers are going to pay their agent and this and that. But this is something different with the VA. So VA hitting the headlines again. This one is VA introduces new last resort loan program to help roughly 40,000 veterans keep their homes from military.com. Followed up by mortgage rates are now at the highest level of the year and could still climb. Womp womp.
Yeah.
And tips for home buyers to save on costs with newly built homes at developers. Some good tips in there. And then some things we need to talk about. And then March home sales dropped despite a surge in supply, but there's some data to support why that won't be the end all be all when it's all said and done. So let's go right from the top today, guys.
Wait. Hey, let's welcome me
Why
back.
not? No, you're already here the whole time.
Yeah.
You didn't go anywhere.
He's like looking at his eyes like, "Are you guys?"
You didn't go anywhere. But
Yeah.
okay, you know what? Let's welcome everyone. Welcome.
No. Let's welcome Yalia into
There
the
you
world.
go.
There we go.
Thankfully,
There you
William
go.
was able to spend his time last Friday, receiving the new baby to the family. So congratulations, Gian.
Yeah.
Lola.
You know the reason
Happy
why
baby.
I was going to blitz right past that is because we're about to do that in another week, and there's like all these kids just lining up. Every show, I was like,
But
"Hey,
stay
there's another
tuned because
kid."
next week there
There's
might be another kid, and
Yeah.
Will might be at another delivery.
That'll be another. That'll be in a couple more weeks. But yeah, you're absolutely right. It's just pretty crazy. One kid this month, next kid, another one for my other son. This is great.
We all just
Being a
decided to shoot
grandpa.
up the club at the same time.
Yeah.
But yes, thank you for welcoming me back.
there it is, Will.
Thank yourself. Thank you to myself for welcoming me back.
He's like, wait, no, don't
Andy
start.
Andy wouldn't do it.
Since I was just here I am. I'm a grandpa now. It feels great.
Grandpa again.
Again.
Oh my gosh, you're
We'll be
going to
saying
go from
this next month
like
again.
Yeah, I know.
2 grandkids to 4. You usually go by 2s, 2, 4, 6, 8, 10.
Yeah, exactly. In twos. That's awesome.
Okay, you guys. First article today is the VA introduces new last resort loan program to help roughly 40,000 veterans keep their homes. Brian actually brought this to the table. Brian found this on military.com. This was really refreshing to see that there's a solution, but I was honestly surprised at how much work had been going that I did not know about and we just hadn't heard about in the mix of all the news and everything. I hadn't heard about how many people had been saved in 23 and 22. So let's just unpack this together real quick. So
I can't take all the credit. I'm gonna give a shout out to Cristian Torres Sanchez. I actually saw him. He was the one that posted this article, and then I was peeping top, so I went to go check it out. So shout out.
This is good
Cristian Torres
information.
Sanchez. Yeah. One of the things I got from this, just breaking it down, is I didn't know that after COVID, they basically all the people that were already in default or already basically on the tail end of basically losing their house. They kind of got screwed over because there was no other help, and they were already struggling through that. So when that moratorium came out, boom, here's the bill.
Yeah, well, here's the bill. A lot of times, the servicer depends on the servicer if they want to go ahead and modify that, right? But a lot of times they put it as a silent second there. So if they refinance down the line or if they did anything, that's when that would come into effect. Mm-hmm. But every servicer was going to operate different. So this is very refreshing. My only thing is, the VA is going to be the servicer now?
So let's talk about some of the details of this. Okay, so this new last resort loan program is intended to help 40,000 veterans who are at the highest risk of foreclosure. Now, a little bit further down in the article, there was a report from NPR talking about 6,000 VA homeowners who were in the foreclosure process at the time. At the time this was when this was being rolled out, while another 34,000 were delinquent. Okay,
Nuts.
so but here's what I need to point out. There's another part in the article. There's 3.7 million veterans that have a VA guaranteed home loan right now. So just over 3.7. The quick math on that is this 40,000 of that 3.7 is roughly 1.08%. So you have about 1%, which are in significant risk at default.
Yeah.
So what they're going to do is they're going to allow the VA to purchase defaulted VA loans from mortgage companies, modify them, and then put them into the VA's direct loan portfolio.
Yeah.
So this means the current servicer that's on the books is going to be off the books. The VA is going to take that back. One of the things I was thinking about is there are folks here who might be in trouble who are also receiving VA disability or some sort of compensation.
Yeah.
And it's basically kind of circulating through the system then. Because on one end, the VA is paying out this, let's say, benefit to the VA borrower. And if they are in trouble and the VA is taking over that loan, the VA is recapturing that So there's going to be a part of this where I don't know how much of it's going to be baked in, but there will be a part where there's like a disability payment cycling, because they mentioned in the article that they're actually going to have a savings. The new program is projected to be a net revenue positive for the federal government, resulting in benefits reduction of $1.5 billion over 10 years. That's because the savings associated with foreclosure outweighs the cost of purchasing the loans.
Which is awesome. And it's crazy because they're actually going to be providing a 2.5% fixed rate throughout the end of the term, which is phenomenal, right?
Yeah, that's the other part of this. So the other feature here is the VA will purchase delinquent loans from holders and become the primary loan servicer, like Will was talking about, providing borrowers a stable payment plan at a fixed rate of 2.5% for the remainder of their loan.
So those of us that said that 2.5s will never come back again, there it is.
Well, that's not open to the market. This is people in substantial default. From the way it's written, this does not sound like an open invitation.
Correct.
My initial caution was, this is going to be invitation. People are going to just go right into default and then go file, and they're going to find themselves on the outside looking in, but that's not what this is.
So they mentioned that it was a last case resort, and veterans cannot apply directly to the program. You basically are going to get handpicked based on the people that are already basically at the highest of that margin.
Yeah.
Yep. It says right there, let's be clear, VASP, right?
Yep.
Is the last resort option that may be available.
Yeah. And to your point earlier about the whole COVID thing with the deferred payments, like a lot of people went into that with the assumption like, it's okay, I'm just going to start paying you when I can start paying, but you still owe all that is back paid. And people, some folks that we've even talked to, they failed to read the fine print or just read the document that was sent in the agreement that, hey, when your loan comes due, all the back pay is due too.
Yeah.
So, so folks who were in that situation or either didn't look or maybe were actually unable to. So it's kind of multiple scenarios. Yeah. I signed the paperwork for the deferment, but I didn't look. And there's people like, I actually can't pay. And then it doesn't matter when it's coming due, it's due and you owe it all.
And here's the thing, guys, we gotta we have to have a better understanding. Every servicer is not going to do the same thing as the other servicer. Everybody has their own guidelines that they follow. I had a client that they went like 12 months without making their payments. So they had a second. And then the rule was that you cannot charge any interest on that forbearance payment that you had. Okay. So what they did is they combined it with this first and modified his first into second, but he already had like a 4.5% interest rate, and they brought him all the way down to 2.75.
Wow.
So that was great for him.
Wow.
Where I've heard other stories, that it wasn't as a huge benefit that way.
And it sounds like you're talking about a person who was like understanding what the deal meant and what it meant.
Correct.
And was, let's say, actively involved in the process versus totally hands off, look the other way, or put your head in the sand and, I'll just go deal with that later. But deal with that later meant, you owe us a bunch of money.
Yeah.
And then now the solution is you either pay us, and if you don't, the servicer has to decide, I want to modify. If the servicer doesn't want to modify, they're going to just put you into the pre-foreclosure process.
Yeah, and that's one of the things that I went in there because I was very interested. Well, what is it going to take to qualify, right? And this is only certain targeted groups that are going to be, and this is our people. I don't know exactly what's going to determine if I'm going to pick you, right, Brian? It just really depends on that certain situation of that person. But it's targeted groups. It's loan status currently of what's going on if they're in default, not having a job. Like, who knows how they're going to get handpicked for this.
Yeah.
Good insights.
There's one thing that they do say here, which I think is important for everyone who might be hearing this or had heard about this and kind of found this segment of the show because of the article or needing help, is this cannot, so this is for people who they cannot resolve their delinquency through traditional VA home retention options. So the VA does have other retention options which are not discussed in this article, and those are, it sounds like those need to be attempted first, and this really is a last resort.
Correct. And this program is going to start May 31st of 2024. So if you do find, and you're a veteran or active service person, and you guys are having these issues, you may want to contact your current servicer to see when, what if you qualify for this
what
program.
your choices
Simple.
are. I mean, and just for
that's what it is.
Just for disclaimer purposes, even this article, the VA officials stress that the program is only for those facing serious delinquent and serious default situations. If you are not in default, this program is not for you. You have to be in default, and you have to be in default a certain amount of time. And this is from John Bell, the executive director for the Home Loan Guarantee Program at VA.
Yeah.
So from the horse's mouth, as they say.
Yep.
And then just some advice: veterans that don't qualify but are still facing financial hardships, definitely be proactive. Talk to your servicers before you get into heavier waters, because then you won't have options. At least beforehand, you'll be able to have some more wiggle room.
Well, I guess this is all happening. The reason why they even want to do this is because before it goes through foreclosure proceedings, that costs money. You hire an attorney. Certain people are coming in, and you already know lawyers take a lot. They become expensive. So what we want to do is, I laugh because the whole NRA thing, and
NAR.
You see,
NAR.
that's how bad it is.
That's okay.
Now.
We could talk about the NRA in a different show.
NRA. But that's how it is, right? Like, we just gotta now try to avoid going through those proceedings where it's going to cost, the banks and the servicers a lot more money. That way, hey, how do we just help the client, kind of detour from that?
Yeah, help the homeowner, right?
Exactly.
Because someone's going to be left holding the bag at the end, right? Because if the VA gets, if the servicer is going to default, if the homeowner and the borrower have defaulted on the loan, and the servicer's like, hey, we got to go to foreclosure. Well, the VA guarantee is a partial guarantee towards the servicer, and so they're eventually going to have some sort of cost associated with that going back into into default. So if the benefit to give and take is, well, if we step in proactively and help these people stay out of default and then bring it under our camp, then that we're already going to have some expense for doing something.
Exactly.
If this is less expensive, then all the better. The veteran gets to keep their home. The interesting thing to me is that this is happening because they've already helped 145,000 people in 2023.
Yeah.
That I was not expecting. I did not know that there were that many people.
Yeah,
so
me neither.
in 2023, the VA helped 145,000 veterans avoid foreclosure and stay in their homes. So now we have the this program, right? The last resort program, which is going to be another 40,000. That will take the total in 24 months to 185,000 homes or veterans in their homes being saved by the VA.
Yeah. That's crazy. And again, I think the government's understanding what happened in the mortgage meltdown back in 2008 when they would just foreclose. You had all these companies just, these asset managers just putting these properties out on the market, getting realtors to put them out on the market. And then we got really inundated with a bunch of homes on the market. And that's when people weren't buying. And when you have a bunch of supply out there, what causes now it's a buyer's market. The prices have the tendency of going down. This COVID really taught us a thing. When they had that moratorium, people aren't paying, it really taught the homeowner, well, if I don't have to make those payments, it's going to allow me to put myself in a better position because now I can save what I wasn't paying. It's okay if it gets tacked on. But now I can pay some of the things that are a lot more important for us right now so that we can just continue moving forward. And this is a great rule because they see that understanding that working with the actual homeowner may far greater benefit everybody. It's like a win-win.
Yeah, I mean, because it's kind of like the bill's coming due, right?
Yes.
So the bill's going to come due to you at one point or another. I mean, think of it this way. So I just did some math here. It's not accurate, but it's just about 5%.
Pretty close.
So it's just about 5%. So a minute ago, I'm saying it's, 40,000 of 3.7 million is 1.08%.
Yeah.
Well, 185, so 2023's plus this new 2024, so 145,000 last year, 40,000, 185, that's almost 5% of 3.7 million. And now that means that VA is potentially experiencing greater default rates than they have historically ever done. Because we talk commonly that VA has been the most historically lowest default rate of all mortgage programs.
Correct.
But if you take a snapshot in time of this last 24 months, it doesn't look like that's true in this little snapshot.
Yeah.
If now cumulatively approximately 5% of these are in some sort of default or avoiding foreclosure. That's actually a really big deal.
Yep.
So these are now on the other side of the coin, people go, oh, that could be inventory for the market. Yeah, it could be. It'd also be people out of homes, and then they're just going to be displaced and going somewhere else. So it's a swap of inventory, if you will. It doesn't necessarily predict that it's going to become new buyers that buy that. It could be investors or whatever. But
it's a win-win. Everybody, banks still make money. They can still do what they got to do, and everybody can still have a house. So I think it works. Everybody got to get their cut. So I think this works out for everybody.
And I think if this is successful, we're going to see more of this because we've talked about creative solutions in difficult times ad nauseum on this show, but I think this 40,000, it's likely to be a lot more than that.
Yeah,
I mean,
absolutely.
This is probably scratching the surface because, again, I'm looking at this one line that just says in 2023 the VA helped 145,000 veterans avoid foreclosure. That was last year.
Yeah.
So
yeah.
wait. So 40,000, is that it now?
Yeah.
Like
No.
probably
There's
not.
more to come.
There's probably more.
This opens the door for other types of servicers or other programs to come about to
Correct.
start helping, because if it goes well here, well then, hey, we're saving money. It's going to cost less to help rather than to just take the asset itself, and then now you're at a real loss.
Exactly.
Cut your ties. At least now you could recuperate your investment on the loan that you did to the borrower and make your investment back over time. Slowly, it doesn't matter.
And to your point, all servicers are different. There might be servicers that go, go with that VA program, or other servicers go, well, if they're offering that to you, well, I'll just do that for you.
Yeah.
Because I'd rather just keep your payment. So maybe this is helping absorb some of that potential increase of people needing help. I'm projecting. There might be more than 40,000 that need this, but I think maybe having the program in place allows the servicer to go, well, maybe I want to do that same thing. Maybe I can financially do that, and that's better for me than just giving over to the VA and getting it off my plate.
Exactly.
I don't know.
Again,
This is intriguing to me.
Hey, another disclaimer: veterans will not apply directly to the program. Okay.
No.
Right.
Which will begin on May 31st.
Yes.
Instead, mortgage holders will identify borrowers in need and submit requests to the program.
Yeah.
So
On behalf,
Yeah.
if you are like, hey, I know we don't have to pay attention to it. If you're going through a certain situation, call your servicer.
Yeah,
and
you can
see,
call your
you know?
servicer directly, and if you do have something you need to reach the VA for, they provided a link here in the article. I'll put it in the description box. They have a housing assistance website, and they
a
also
phone
have
number.
a phone number, so 877-827-3702.
Yeah.
Any last thoughts on this one, guys?
No, I just think it's great. It's a win-win all the way around.
Yeah.
You know, again, COVID taught us that, and that's why I think servicers and asset managers aren't so quick on just putting homes on default. Everybody's thought it's going to be like 2008. We're going to see like the mortgage meltdown, all these homes being out there. But no, I think servicers learned a lot through this, pandemic that we had. There was a lot of learning in so many different ways.
Yeah, this is definitely a stop-gapping tactic. I think there's going to be more of that. I'm really interested to see how this plays out. And I'm really happy to see the VA do that. That just makes me feel like confident in the very lack of confidence I've been having in some other things I'm seeing regarding the VA. This is confidence inspiring.
Yeah.
I like it.
Thanks, Brian, for bringing that article.
Yeah.
Brian, thank you so much. Welcome back to the show, Will.
Shut up.
Since we're asking for recognition now,
Yeah.
give me my love.
Okay, guys, let's turn the corner. Mortgage rates are now at the highest level of the year and could still climb. Thank you for joining us. See you next week. I don't like this, guys. I mean, I know what's happening. I watched the 10-year yield because I'm a big dork and I'm a nerd, but like mortgage rates, ever since that inflation report came out, just tick, 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 tick.
So I'm gonna try to give it a positive spin on this. I know rates are bad.
Go for it.
But this last week, I have been speaking to a lot more buyers that have been interested, first-time buyers. And one of the things that I found very interesting is that the conversation changed from why are rates so high to, hey, how can I get into the house and what can we do? So the conversation is like, hey, I'm aware that rates are high, but I don't see anything changing. I quoted a lady yesterday a rate, and then she said, hey, I showed it to one of my friends. She's like, no, it's way too high. Oh my God, why are you going to buy right now? And she told me that she told the lady, look, I understand that you bought 2 years ago when rates were 2.5%. Unfortunately, that's not my decision. I have to make a choice based on what's happening today. This lady's obviously, she's going to sell her house. She has money to come in out of pocket, but she's like, hey, I understand what's happening.
Yeah.
I don't see things going down. Houses haven't crashed. If anything, they're more expensive. Like, I have to go take my cuts now and see what it looks like to really know if I'm going to make the move or not. And that's more or less the demeanor that I've been getting from a lot of buyers that I've been speaking to. I'm like, hey, I'm gonna just try it out. Like, things aren't looking like they're going to work out or come down. So I got to see what it looks like for me in reality right now.
Yeah, I mean, that's one client, right? Then you have a lot of other clients that are currently approved, and they're just going to pump their brakes right now because now their affordability is not there.
Yeah.
Another increase in 0.25%, that could mean another $80 to $180 a month, depending on what that loan amount is.
Oh yeah, 100%.
So I know I have a couple clients that I just can't do it right now. That $180, that $150 is detrimental to my monthly, and I'm just going to put a pause right now to see what happens.
It's already the limit, right?
Yeah, the bad thing about it is kind of like, here we go again. We saw this back in October. It's like crickets, right? When the rates went up, it was like, boom, things just froze. And this is the highest rates we've seen this year, And so we're barely 3 months into the year, and here we are with these high interest rates, and home prices have not gone down.
No, I mean they came back because January rates went down and October was this high. Everyone touched the hot stove and like, oh, I don't like the 8%, and then the market kind of gave up a little bit, and everyone was expecting the Fed, who was being data reliant and data dependent. Oh, the Fed's going to make all these cuts in 2024. Doesn't look like that's going to be the case anymore as far as many cuts as they were going to.
Exactly.
They were projecting they were going to do for the borrowers, like you guys are talking about. It really, to me, I summarize it like this: it's really just attitude versus ability.
Yeah. Exactly.
I'm unable, so I cannot.
Yeah.
Or I'm able and I want to.
Yeah.
And I know it's not every scenario is that easy to just to like make that just a common denominator, but I think that's just what I'm saying I'm hearing the most of is there's the mathematically ability or inability, and then the desire, I do or I don't. Mm-hmm. And yeah, you're right. I mean, great point that your client made. Like, I can't go back in a time machine 2 years ago and get a 30-year fix at 3.5 on a conventional loan with 10% down, 20% down, whatever. I'm not going to get a VA at 2.25 from 2021. It's not there anymore.
Yeah.
So, and the article kind of points this out too, because they're saying anyone waiting for rates to drop significantly may be waiting for a while.
Yeah.
And Brian and I talked about this, or missing out altogether. So there's kind of like a FOMO mixed into this, number one.
Yeah.
With the attitude. Yeah. They may be waiting a lot longer than they thought because you still have shortage of inventory, even though inventory has made a little bit of a comeback. That has not actually generated enough closed sales, as we're going to see in a minute.
What happens is I feel like as soon as the inventory comes, people flood, and then we go right back to where we're at. So there's not enough time for the market to assess like, the inventory and it's a cool down because everybody just jumps on it right away.
But remember, last week's show, we were talking about how there's homes that are just changing hands investor to investor.
Yeah.
And 20% of the homes from December to December last year, year over year, was from investor to investor.
Correct.
So that means 1 of every 5 homes isn't even offered to your client or your client. So 80% of the available inventory, if you will, is this resale or new buyer or buyer new build, because there's a percentage already baked in that's just going to go to the next investor, and you're not even going to get a crack at it.
I mean, the good thing, guys, the difference between today and last year, we have $120,000. There you go. 120,000 homes more available now than we did last year. That's about a 30%, increase if you did that math there, Andy, and you're good at that. But that's a good thing. The only bad thing about that right now is, and this is nationwide. This is not just here. We're talking about nationwide numbers. I believe there's a little over 526,000 homes now available, which we've been fighting in that 400, 500 range. Yeah. So that's a good thing. Most sellers are now considering they're like, okay, this is the new norm. This interest rate. So now I don't think I'm going to go back to those lower rates, et cetera. I'm just going to put my house on the market. You know, it is what it is.
Because now you're swapping one thing for the other, right?
That's
so
correct.
We talk about rates and we talk about home prices, and what that means to a seller is, well, if there was no collapse of price, well, that means now my equity gain is still there.
Correct.
And over the course of every month I'm making my payment, my balance is going lower, my equity has stayed the same, had a dip, came back up.
Yeah.
So maybe what is best for them is, well, the rate isn't favorable for me to list and then go buy a house for myself at the new rate, but I may have the same or more equity. So now I have, the rate's higher, but now I have more money.
Correct.
So there might be money to play with for a buy
And
down.
they also they also understand being a homeowner is way different from a first-time home buyer coming into the market. They already understand the sequence, the seasons that come with owning a home, right? With the interest rates and all that. So they already see that this is temporary. In a couple, hey, we thought this year where it's going to be 8. Remember last year everybody was saying, there's going to be 8 rate cuts. Well, we have 8 meetings. Like, what the heck? No. Okay, so 8 rate cuts. Okay, good. And then we predicted that you guys were, if I recall correctly, it was like around May-ish, what have you.
I said they're going to be 3 to 4, and they're going to start in April. And that's not going to happen.
Oh, yeah.
And now...
No chance.
And now they might not even be, right? Because what's one of the most important indicators to this, for the Fed to, is one, it's going to be inflation. And the other one that's really important is the job market. They still haven't hit that, guys. Like,
I know. I know.
Jerome Powell is just a lot like... Does he know what he needs to be doing right now?
They're honestly really stuck because the second you start telling people we're going to be data dependent on our decision, which means, okay, now the data is going to drive the outcome. And that's fine if you were already confident that it's going to go in a certain direction. But now I think what's happening is their confidence is getting undermined by the data itself.
Correct.
I think they're not able to accurately predict when inflation is going to come down, and they're just kind of beating around the bush. But on Friday, if you're watching this right now, core PCE comes out, and that's going to be a huge determining factor of where the rates are going to be heading in the next weeks to come.
Yep.
So definitely pay attention to that. And I feel this week has just been volatile, and it's going to continue to be so until we have some certainty. And the Fed haven't been able to give us that certainty. Therefore, that's why we're running around in circles trying to figure it out.
Because they don't even know.
They don't.
Brian, they're confused.
No,
First, they were like,
don't.
oh, okay, we're going to slash our rates. And now it's like they're confused again.
Yeah, I mean, I cannot argue that this is what they were hoping for. I just can't. I don't think this is what they were hoping for. Mortgage rates trending alongside the 10-year yield and people's reaction to inflation and jobs.
Yeah.
Like, and we talked about this last week. The softening in the jobs market did not happen at the rate and the frequency at which they expected it to. Because even though it might look on the surface like, oh, inflation's killing everybody. Well, it is, depending on what you're talking about. Yeah. But then it's not, depending on what you're talking about. Because in some parts of my life, inflation's killing me. In others, it isn't. But I think what's happening for people who maybe are cash strapped or don't have, like, let's say, income that can keep up with inflation or savings, they're using their credit cards, right? Because we see the credit card balance go over $1 trillion and stay over $1 trillion and keep going. So people are still paying for things. But then what that dovetails into is, oh, well, if it looks like they're still paying the price, then the people, the retailers don't have to drop the price.
Yeah,
and if there's no flood of inventory, you don't have to fire sale anything.
Yeah.
So in the same regard we talk about with homes on the consumer side, well, if there are no drop of prices, then and people are still paying it, whether it's a credit card, cash, or whatever, well, then it looks like they can still pay it.
That's correct.
And so then now it's not transitory; it's baked in.
Yeah,
and that's just going to be the new reality.
It's
to your
the
point.
new norm. Like I said a couple weeks ago, Applebee's ain't gonna relaminate their menus, bro. This is the new norm. This is it. You're gonna pay $10 for that hamburger. It's not gonna get relaminated.
No joke. In February, there's a little place that Jen likes to go to down in Bonita. It's a little Mexican taco. It's a hole in the wall taco shop, right? And we went, and like it still had most of the pricing on the board, and a couple of them had like the white paper.
I've seen that
marker over it. Okay, so we went 2 weeks ago, and all of the pricing is covered.
Whoa!
And none of it is rewritten over. So their actual menu has no pricing.
Wow.
So it's basically telegraphing. You just order whatever, and the number's gonna show up on the thing. And that's what you're gonna pay. You're gonna pay
the new norm.
Yeah,
we're tired of changing menus.
I've seen that at restaurants.
Well, so their cost is obviously changing. Their cost of employment is changing. Their cost of getting their raw goods is changing, and the cost of offering the service of the food. But I'm talking from February to now to April.
I'm telling you guys, it was and I share this again. Tanya and I went to go eat 2 tortas, We love this place. And then I got a freaking drink. It was $32.
Yeah.
Like, what the hell for 2 tortas? And I'm going to go to TJ.
Yeah.
You know what? It's even expensive over there. Their peso is
too.
Actually performing quite well right now. So I don't know. But yeah, in this article, it does say recent economic data shows that the economy and job market remain strong, which is likely to keep mortgage rates at these elevated levels for the near future.
Yep.
So they already, all these economists and people that understand the market, they're already telling us. They already have that crystal ball.
Remember a couple years ago, guys, I was like, hey, the Fed's word of the year is going to be transitory and the soft landing. This year's Fed motto is higher for longer.
Yeah.
Higher for longer, brought to you by the Fed.
There you go,
Okay, next article, guys. Here are some tips for home buyers to save on costs with newly built homes. I actually agree with a lot of these things, but then I actually have some hesitation, some input to maybe put on the table for you guys to tell me, wager whether it's a good idea or not. So the general idea here is that you can keep the cost of buying a brand new build down by passing on some of the upgrades they could be doing along the way before they hand you your keys and hand over the home. Now, I understand that, and the difference could be that, maybe it's $5,000 or $10,000 versus $50,000 or $60,000 or $80,000. So there's a big variety of cost potential savings. The thing that I wanted to put to you guys is, what would you recommend that to your buyer to wait to do the upgrades they want later when it might not be warrantable as it would be if the builder does it? So if the builder does the work, usually it comes with a warranty for a certain number of years or months that if they have to come back and repair things, it's covered under that. If you wait till later to do those things and you spend $20,000 out of pocket, well, then that contractor would have to give you some sort of warranty, or the product they use has some kind of warranty. So what do you guys kind of make of this general idea?
I mean, for me, I think it just depends on everybody's circumstances, right? Like for me, when I bought my new home, I want to throw everything in there. Why not finance it? The rate's going to be like 4.25%. I'd rather finance that 4.25% than use my own money. If I had it specially invested in other investment vehicles, which is the norm. And that way, the way I look at it is, hey, That's a tax write-off for me. All the interest I'm paying into my mortgage is a tax write-off. So I look at it like that. But not every buyer is going to look at it in that sense. They're going to look at it like, well, why is it going to cost me $20,000 when I can actually get somebody else to do it for 10?
Yeah.
Yeah.
You know? And so those are kind of like you got to identify who you are, where you want to be at, and you know what fits your budget.
Yeah.
So
we did a couple of shows ago. We actually had someone put a comment in because we were talking about new builds and all that,
Yeah.
and someone actually put the comment in that they actually had to go and retract and like go scrape back their deposit because the builder wasn't doing the upgrades, and they were making a comment in our feed about how we actually had a situation where we had to walk away from our dream home. We had put our deposit down, put our other house on the market, and there was this whole story connected to it, and they actually had to come and claw back their deposit, cancel the deal because the builder actually wasn't acting in good faith. And they were able to get their deposit back because of that.
Gotcha.
So there was a builder that they had trusted to do that. This is kind of why I'm asking the question. They had trusted to do that. That particular builder, it was in a different state, didn't do the work they were supposed to, and because they didn't act in good faith, this person who commented was able to get their money back.
Wow, that's
so
awesome. Good job.
There may potentially be a risk in that because this is one person's story,
Yeah.
but they're probably not, they can't be the only one in the country.
It depends where you're at. We're in San Diego. There's so many builders. Right. And they're so protected here that if it's not going their way, they can just get that earnest money deposit because we have certain contingency timelines and see you now, I'll go somewhere else, you know, but I do like put all my upgrades in there. I'd rather go into a home being turnkey. You know, than having to worry about hey, I have to put this now, it's new, then I have to add that. I'd rather just go in it.
Yeah, I mean, especially if you're not questioning the builders, their intent, that they're actually going to do it, and they're going to follow through, and they're going to do it at a good quality workmanship and craftsmanship.
It's kind of like going into that brand new car, right? Like you go in there and it's like, it smells so good.
Straight out of the factory.
You know, and then you get to pick the paints. You go to I like that.
Yeah.
I don't know. I'm cool with that. But again, what's important is that the value has to come in.
Well,
because if the value does not come in and you over added these upgrades, well, then you have to pay the difference.
Yeah, and I think you brought up a good point. It comes down to the situation because also kind of when you buy a new car, there's different kits, there's different trims, and that also comes at a premium if you want the nicest one, right? So I think also if you wanna finance everything, you also got to make sure that you can afford it on the debt to income ratio. So I think it really comes down to your situation. Some people could be like you said, like, hey, I have a family member that could do this for the cost of the material and some beers. Yeah. So it really just depends for the person if they want to do it themselves. Some people are like DIYs, they like to do it themselves regardless. Other people are like, hey, I work all day, I don't even got time to be in my backyard, so I want to just come and make it look all good already. So I think that's a really good valid point that you said. It really comes down to the situation.
No joke, before I came in today, guys, I had to actually call a friend of mine. I'm like, hey, so I got this kind of situation, I don't know what to do, so I'm going to call you because I know you know what to do. No, it's super easy, you can just do it like this. I was like, no, I called you because I cannot do it. I already know I cannot do. It's easy for you, which is why I'm calling you. So I'm not that DIYer for a lot of things. I am for some, but not for what I called about today. I was like, no, I need someone else to come fix this.
Personally, myself, I'd be I know enough people that I could kind of influence them to come over and work on my house, and we can kind of work something out.
Yeah,
and,
I like saying I'd rather have it done right rather than done twice.
I'm definitely not a DIYer. I can't even build something with instructions. So.
Better done right than done twice. So to your point about the kind of maybe having choices memo and Brian DIY, this report says almost half, 46% of homeowners use cash from savings to cover renovations.
That's what I thought was crazy.
And that's a lot. 20% use credit card, and 7% refinance an existing loan. 5% use home equity line of credit.
That's what I thought was the craziest. 5% only use their equity, and you would think like, hey, that's I could just wrap it in, have a low rate, but people don't see it like that, and it's crazy because it's like I'd rather go fork out this money than put more into my house. When if you do the math, getting a regular loan on that is going to be literally even more or slightly the same.
Yeah, exactly.
But at least you get a lower rate and you could have more benefits and being able to.
And I think it's highly situational, right? I mean, someone's sitting on a fat stack of cash and it's only $20,000. They're like, well, maybe that $20,000 dent is not worth me taking a HELOC out for.
Yeah, exactly. Well, here, I want to give you guys a scenario right now. And this is not a new home purchase, but it's the client that wants to put substantial amount of money down. Right. Mm-hmm. And you guys know when we ask for all the documentation, we ask for like everything except for your DNA. Right. But we're getting everything because we want to analyze their current financial situation. We want to see what they're doing and what we can how we can just guide them through this process. So he's like, yeah, you know what? I have my retirement and I can take X amount of money to put a big chunk of a down payment on my house. right?
Yeah.
So I'm like, okay, well, let's see if that's going to make the proper sense. Well, I look at his statement. He's making like 14 point some percent return on his money.
Oh.
Right? And he's got 253,000 there. So I'm like, well, why take 50 or 100,000 when your mortgage is going to be 6.5? You're already, there's no need for that.
Yeah.
You know, if you have that money already tied at 14 point some percent, you're already, that's going to help you really make some of that mortgage payment instead of depleting your savings. So when he looked at it, he's like, whoa, nobody's ever told me that.
Yeah.
Right?
Yeah.
In the past, I purchased my house, I put these out, and I go, no, for me, the way I look at it is you have two investment vehicles.
Yeah.
Now, you have one at the 7%, then you have the other one at 14%. Let's leverage that both. And he's just like, whoa, bro. And I'm VA, right? I don't have to go in there. There's an officer. He's like, luckily, he's been saving a lot of money into his TSP, and he's just killing it. Wow. So I'm like, good job, because normally when I see those, they're only making like 5-6% return, you know?
Well, so real quick, the asterisk disclaimer. Some people are going to go, well, of course, you're the loan guy. You're supposed to say that. So what would the difference have been in the loan? Because, oh, well, he's going to make more commission if the loan's higher. So what was the difference in the loan?
There really isn't much higher. If you put 50,000, you know, it's not that much higher.
That's my point. So my point is I'm getting ahead of this because I
know.
already know what's going to happen. People are, oh, well, of course, he's going to sell the higher loan. Well,
no.
On 50,000, what's 1% of 50,000, guys? It's $500.
Okay, so if you're paying,
so let's say you make 1% on a commission and it's $500. That's the difference. That's not that helpful.
I mean, it's not making anyone else richer.
No. I mean, again, you're borrowing at 6.5%. Your interest to your payment, thank goodness we have that. That's a tax write-off. So it's a benefit to somebody who's making good money. Right? So that difference, if you have another investment vehicle or earning 14.6%, I'd rather fund
let that run.
One.
Yeah,
because the equity here already that I'm making on my house is already
take care of itself.
You know, let's say 5% conservative on a $1.2 million house. Come on now, guys.
Well, in that scenario, that matches up with what you're talking about here, with what they're talking about, with 46% of these people using cash from savings. Yeah. Well, and you're not talking about savings, of course. It's obviously something that's invested, but it's the equivalent.
Savings when they're making 1%.
Well, it's the equivalent when it comes to defining something as cash. Okay, so if I take money out of a retirement account and I convert it to cash, and then I use that cash to work on my place and renovate it, that's still cash. But 5% using home equity does seem a little low to me. To Brian, to your point, 7% refinancing existing loan, that makes sense. It's super low. Yeah. It's not the right environment to do a full cash out unless you're also paying off debt and you're also got a plan for how to get at a lower rate later, or you're moving in a couple of years. There's something else going on. You're not just doing this one time because you want new bathroom tile. That's probably not the right way to do it.
No.
There have to be other things baked in there together for that to make some, I'd say, mathematical justification.
Yeah. Yeah, and simply what I'm getting with this is your team's going to help you identify these things, whether you're going into a new build, what's going to be the best. So just look at those things. When you're going into a new home build, like look at yourself, like look at your numbers. Do I really want to fork this out at a later time or do I want to just go in there now and put it in there? And we also got to remember 6.5%, that's usually right now to 7% conventional. We got to remember that in another year or so when rates go down, you're able to refinance and now that money costs you less.
Yeah. Yeah.
So it's not like we're going to be here for 30 years because some people will probably say, whoa, if you didn't put that money down, now it's 30 years, calculate that number, But no, that's not the case here. The rates will go down. You could refinance and now you're actually borrowing that money, for a lot cheaper.
Yeah. Well, last thought for me on this is that, if you are in a new build and you do not have agent representation, you are representing yourself to the builder. So something else, and they don't talk about this in here, but you have to be aware of what is the work list, what's the work order, and what change orders need to be made midway or halfway or however long you're in the process you are, because you're basically self-representing if you are an agentless buyer in a new build situation. Just go in knowing that you're going to have to fend for yourself, represent yourself, and you're going to have to make sure with the builder that timelines are being met and certain milestones are being met on the dates they're supposed to be, and at the quality they're supposed to be done.
Yeah, and read that 50 to 100-page contract, right? You're going to have to read it because that's usually what it is. And what's crazy is when you put your name on that list and you go, they'd ask you if you're being represented. If you don't put that person there, then that's it. You're representing yourself.
You're on your own.
Or sometimes you do put that, but if that agent isn't there physically, you can't put them.
Sometimes they won't do it. Yeah, you have to be there in person. You can't
And
just slap
I wonder,
someone's name on
yeah,
it.
and I wonder why, right?
Well, they don't. Yeah, come on. They
terms
don't.
get,
They don't want to pay a commission to the agent. But
One?
in this scenario where someone may be doing those upgrades as part of their purchase, again, here's your choice. You do it with your agent who can represent for you and stand in your defense for certain things or advocate for you or not. And it's your choice. I don't really care. I'm not saying you should have one or the other. I'm saying
No, you should.
I'm just devil's advocate. I'm saying
Yeah.
I don't care which one you do. I definitely think you should have an
should.
agent. But
you
look,
should
if
do
you
one.
don't, just be aware
Correct.
that you're going to fend for yourself and you're going to represent all the different things that need to get done along the way.
Yeah.
And that's on you.
So might as well sign up for the DRE and get your license.
Yeah,
Get your license.
good point.
1,000 new realtors
Good
join
point.
California real estate the month of April. Okay, guys, home stretch here. The last article today, March home sales dropped despite a surge in supply. Here's why. Quick bullet points up top. The median price of an existing home sold in March was $393,500, which is up 4.8% from the year before. So March 23 to March 24. Inventory did improve slightly, rising 4.7% month to month to 1.11 million homes for sale at the end of March. And regionally, sales fell everywhere except in the north, where they rose 4.2% month to month. Sales fell hardest in the west, ding, 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 our home, down 8.2%, and prices are the highest in the west also. So here is the difference right up front of people getting into contract when rates are low and closing when rates are on their way up. I think that has a lot to do with it. Inventory does not necessarily predicate closed sale figures. We
Correct.
know that. We know that escrows fall out. We know that people don't qualify at the end. And in a moving environment where maybe they were at 6.25 and now they're at 7.25, that mathematically eliminates some people. It's going to put some houses back in the market. Up front, I'm not surprised by this. On the backside of this conversation, here's what I'm looking at. So now that rates have jumped again, and we're in April 2024, and they're the highest they've been in 2024 so far. What is your prediction for May and June closings? Are they also going to be slow and lower?
Absolutely. Oh yeah, I see it. I see it that way.
Yeah.
Absolutely. I'm telling you, I felt the difference right away. As soon as the rates went up, I could already tell this is going to happen.
Yeah.
You know?
Yeah. So if there's
there's also been a 32% in comparison to last year. It's been a 32% more price reductions this week than it was last year.
Yeah. Oh, 32% of listings having price reductions.
Correct.
Yeah.
One of the things I've noticed is that whenever rates go up, it's like consumers are lagging. They make the move after rates go up because they heard that rates were on the way down, but then they're lagging on that information. So by the time they do get in the market, rates are already up, and they're like, "I thought rates went down." And we're like,
Exactly.
yeah, but you're listening to that information so backtracked that by the time you are in contract, you're like, "Yo, what rates are back up?" I thought
That's true.
I
That's true, but also there's just the byproduct of being an escrow. So unless you're closing an escrow on the same week you open it, the rates are going to be volatile and they're going to move. So if you're like already have a rate lock, then you're fine. You're already locked.
Yeah.
But if you're not, then you're going to be in escrow at the time you're trying to lock a loan in an increasing rate market. So we're in an increasing rate market as we have been since the inflation came out, and that's going to make people pause. Some are willing or going to your point earlier at the top of the show. Some who mathematically can't, won't. And then we're probably likely to see May and June home sales be low as well because of this rate effect.
Absolutely. Again,
So you have inflation, you have affordability, you have income qualification disparity, all
That's the
working
one.
here. And even though inventory is higher than it was last year, it says here, inventory is now 14.4% higher than March of 2023. Well, here's the question. Does that even matter now?
nope.
Like, that's great that it's higher. That's wonderful. We've been begging for more homes, right? We keep talking about inventory until we're blue in the face. But then now it's like, okay, well, that's fine. You have a smaller pool of people now to buy that higher amount of inventory.
Exactly. And I was going to say again, it's affordability. It's an affordability issue. It just continues to be that. You know, if your salaries aren't going up, but the interest rates are going,
you're losing regardless. You can't do nothing about it.
that's it.
Your buy power is evaporating.
Well, we talk about FOMO a lot. You bring up FOMO quite often, and we talk about the people having the fear of missing out. The spring housing market is getting more competitive and moving faster. The typical home sat on the market for just 33 days compared to 38 days in February. Now, that's a 5-day difference in just a month over month. That is definitely indicative of people having FOMO and like, hey, you know what? I'm just going to get in. I'll worry about what this is costing me later. If I can afford to get in, I'm just going to go do it. I mean, off camera, again, this is the conversation I had with somebody this week.
Yeah.
If I can get into a home right now, I might as well, because now prices are come back. Rates are higher than they were. I can't go back in the time machine. I can afford with my income, dual income with me and my wife and our situation. I might as well just go do it. I mean, it was almost like defeated, but excited. Like excited. Oh, well, I might as well go do it because I'm already paying out the nose for rent. Might as well be going to a house I own.
I had 3 of those conversations this week, and I wrote it down on my notes because that's literally what they said. I can't do nothing. I need to see if I can get in. If I can get in, I can get in. If not, well, shit. At least I know where I'm at right now.
Yeah.
But they're just like, it's almost as like they're not desperate, but it's like, hey, I see rents just going up.
Yeah.
I don't know if I could continue to do this. So like, let me just roll the dice and see if I could get on.
Yeah.
I think people are just resigned to the fact that this is the way it's going to be. I mean, you mentioned new normal earlier. I mean, you have Lawrence Yun, the chief economist from NAR, talking about this and saying that,
I think slowly over time they started conditioning the consumers to start thinking like this, and over time, like they kind of caught on that it's like, hey, higher for longer, this is the new norm, and eventually people are like, hey, well, I can't do nothing about it. If I can't beat it, join it. And
our government killed the housing market. They're killing it. They're killing, and they still don't know how to get around it, how to make it better. They're just killing it.
Yeah, I mean,
they're
really
truly
sucks.
making this nation a renter's nation. Is the way I'm looking at with everything else that's going on.
Yeah, I mean, when you scrape back all the details and the nuance of the things we talk about and the very detailed like specifics, it just looks like it's conditioned and primed for there to be less personal ownership and more corporate ownership and more and controllable conditions.
We talked about like, welcome back. Will, you're back, right? I did have a granddaughter. My new motivation now is my grandkids. Mm-hmm. I keep telling myself, and I keep telling my clients, for your kids and the generations to come, in another 15, 20 years, is it going to be as easy to get into a home as it is now for them later?
No.
Right? And so that's one of the things that I use with people is like, just think about that. Look at all the challenges that we're currently facing. Look at the market conditions that we're currently going through. Look at the affordability that we're going through. Mm-hmm. Is it going to be easier or harder? And I know for a fact it's going to be harder.
Yeah.
So it's like, get in it now.
Yep.
Yeah.
And last week, Brian and I were talking. I'm trying to call up the article really quickly here, but last week, Brian and I were talking about the number, the top 5 states, what percentage of the homes are owned by investors, and California leads the pack. And it was like California, New York. I can't remember the names. I'll look it up here. But so part of your question of being legacy, future forward looking is, what state are you in?
Yeah.
Where are you? And is there accessibility to homes in your state? I was so surprised / discouraged about how many states that are I considered affordable to get into first home ownership, who have greater than 30% owned by investor groups.
Yeah.
And it's not owned by the individual or the family. It was like Kansas was one of them. New Mexico was one of the other. And I was like, how are Kansas and New Mexico on this list for a percentage? So it was like California. I think it was like California, New York, Kansas, New Mexico, and Tennessee. And it's like, how are these places all? How do these states have more than 30% of their properties owned by investor groups? Wow. I get California.
Yeah.
I get it. Okay. But I don't get New Mexico. Yeah. I don't get Kansas. It doesn't make sense to me.
Yeah.
Because those places also have so many lower cost options to get into homeownership. The barrier to entry is really low.
Do you foresee maybe those markets picking up in the years to come as people are starting to move into them?
Possibly. I mean, look, there's got to be an economic impact here, right? There's got to be jobs, availability of jobs, cost of wages, cost of living, but also what are you actually earning? And I think that's part of it too. But I'm just saying that I was surprised when you're talking about the legacy and do this for your kids and then your grandkids. Like, well, okay, but what state are you in?
Yeah.
Because some of these states, we're going back to last week's show, but some of these states have really high percentage of homes owned by institutions. I'll say institutional owners, and then behind that you have 20% of home sales being done from investor to investor. Yeah. So you're competing against both of these factors right out the gate, which makes your point even more important.
Yeah, yeah. So that's where I'm at with all of this, guys. It's just, our nation's becoming a renter's market. It's what it is. I'm not going to let that for myself or my family.
Yeah.
That's why I'm building my ADUs. I'm trying to go into the investment side of things because I want to leave some type of legacy.
Yeah. No, that's awesome. I mean, and people who are in that situation, obviously I'm saying this for you, but your recommendation is do the same.
Yeah.
And if you can do the same, then do the same. If you cannot, then obviously you cannot.
And here's the thing, guys, most of the people we talk to, obviously they come to us because they want to get into a home. But when you hear their stories, you see what they talk about. Like one of my clients, living in North Island for 25 years. He's been lucky to have PCS orders just in San Diego for the last 25 years. Living in, well, we already know, our military has some of the best views out there. They have some of the best pieces of land here in San Diego. You go to North Island, oh my God, it is beautiful. Yeah. You have all Point Loma, Coronado. It's so nice. And when you're living on base, on the housing, not on base, but on military housing there in the water, why would you want to leave?
Yeah.
Right? But think about that. If they would have bought anything 25 years ago, how crazy that would have been.
Yeah.
I bought my house in 2013 here in Rolling Hills. Thank goodness I did that. That house right now, it's crazy what people are willing to pay for that and what their mortgage payment's going to be. And yet I'm sitting at $2,800 a month, taxes, insurance, and everything get your way.
You hit the bullseye on the market, like right in that neighborhood. You totally hit the bullseye.
Right. That and you see my other investments, they're fine. They're good. Thank goodness I did what I did. Because now we're leaving some track of, of legacy there.
Yeah, well, you have options now. You have options, and then now you have kids who are all going to take them, and grandkids are going to take them.
And they will, right? So more of my story is, just like the stock market, it's not timing of the market. I wish we would all hit at that right time, like when Bitcoin was what it is. I know I'm going sidetrack here, but hear my point. It's time in the market. Just go ahead and it's longevity. Things will happen and you'll start adjusting. Like I had to adjust back in 2013 when I bought this other home. I thought that payment was going to be high. I had to go to a Jack in the Box and all that dollar menu. Now it's a value menu. We adjusted. We'll adjust. The funny thing of our world, we start to adjust to our new normal.
Yeah.
Right.
100%. Yeah. And so I don't know if you caught this or not, but I'm going to tell you what it was. The California led the U.S. for home investor share in 2023. So California, 35% investor owned. Georgia, 34%. New Mexico, 33%. Kansas, 32%. Then Texas at 31%. Nevada, 31%. Arizona at 30%. I thought Arizona would be super high, right?
Yeah.
Vacation rental market, short-term rentals. Okay. Tennessee at 30%. Utah at 30%.
Whoa, Utah, huh?
Right. Weird. Now, here's the other tricky thing. There were only a handful of states that had less than a 20% of investor share. Those states were Wisconsin. Okay, that makes sense, right? Okay. You can afford to get there.
Wisconsin.
Louisiana. That makes sense. Yeah. Low barrier to entry. North Dakota. Low barrier to entry. New Hampshire. And South Dakota. So all those places had a lower. So I thought, again, I know I'm overstating this, but I honestly thought New Mexico and Kansas would be in this other group of less than 20% investor share.
You just got to see what the appreciation levels are in those areas, right?
So
I mean, North Dakota, South Dakota, I wouldn't. Of course.
I know you're not trying to go there.
I brought up that story last week.
Devin went to school there. I saw it on first hand.
No, I'm saying you're not trying to go buy there.
No, thank you. You can't. Why would you put your money there?
What was that property you showed me from Detroit that was $20,000, but the rents were how much? And it was kind of like, that kind of is a lot for where you're buying it for. It was like $20,000, but the rents were like $1,200.
Exactly. I was like, what? This home
Brian, come over here.
2,800 square foot home.
There you go. Yeah.
And it was selling for $20,000.
But the rental market was like over $1,000, and you're like,
I know.
What? I was
like, I'm like, I should buy more properties.
The rent
we should go to Detroit.
The monthly rent sounds right. The cost of acquisition.
So
remember, I said I was like, there was a house. You're like, wait, what's wrong with the house? I'm like, yeah, exactly.
No, we saw the house, but around the area, that's what they were selling for, like anywhere from $20,000 to $50,000, and the rents were actually pretty nice. They were like $1,000 or $1,100.
Even at $50,000 is screaming deal. 20 is like, okay, there's got to be something wrong. I was like, I don't know anything about it. I'm like, that's crazy.
I told Will, let's just go half on the neighborhood.
Half on the
buy a block.
I'll take the next one.
You buy the even numbers. You buy the odd numbers.
But again, a lot of times it sounds like you're appreciating your money, but in some areas when you're doing that and the equity stagnant, you're actually depreciating your money because of the wear and tear.
Yeah.
Right?
Yeah.
Of the home. You're probably you probably think like, yeah, I'm making money, but then when your tenants go in there and all that wear and tear, you just may not be making money.
It's just maybe a longer time frame than you're hoping for.
And I have a lot of investor friends that are like that. They're like, you know what? I'm getting out of here. Yeah. I don't want that. I'll sell that portfolio and go somewhere else.
Yeah.
You bring it back to California with all the tenant laws and everything. Now you see investors still want to be here.
Yeah, they are. Yeah, and they are. I mean, guys, Yeah, it's so crazy that the landscape has changed so much. And it's easy to say that like ad hominem, like, oh yeah, of course it's changed. Everything's always changing all the time, everywhere, every day. But like specifically in mortgage and real estate in these last like 2 years, the 2 years of 2020 and 2021, massive change. And then 22 and 23, massive change in the other direction. And so that whiplash effect, I think, is just spilling out everywhere to consumers, and it's really causing a lot of problems. Look, yeah, the government's got their hands dirty. The Fed's got a problem on their hands. We're not out of this. It's not going to be right now. And again, the Fed's own words, when they're showing us blue charts with dots on it and their dot plot chart, they're like estimating that things are going to start being where they want them to be by 2026.
Yeah.
So in 2023, when I'm watching this in the fall of 23, am I supposed to be like, oh yeah, everything's going to be great next year because they say in 2026, it will be the way they want? Well, shoot,
it hasn't been the way that they wanted for the last 2 years.
It might be 27.
Yeah. I hate going through all these other things, but all these things keep coming to mind. We're talking about the corporate world. We got to remember, you got the BlackRock, you got Vanguard. Bro, I did not know this, but their economy is stronger than Germany, stronger than England, stronger than some of these countries that are out there.
Yeah.
That's how much power.
Yes.
So although we think, oh, it's just our federal government, do we think they have some type of influence in any of this?
They're worth more than a lot of countries.
You know what I mean? Like, it's just crazy.
Yeah, they have a lot more assets under management. They're valued more than several nations.
It was what, like 13 trillion?
I don't know the exact number.
Something like that, but
I want to say it was 13.3.
Yeah.
Something, I think that's what I heard. That's my mind's telling me. But
Trillion.
Yeah.
Trillion.
I know.
And then when you go and you see what they own, which is, you can Google this, you can go and see what Vanguard and BlackRock, and you already know BlackRock owns some of Vanguard, so they pretty much own everything. But it's crazy.
Yep.
This Flynn guy is just, man, crazy. Crazy what they've done.
So
another talk.
We have a whole show about that.
Yeah, it has to do with a lot of this.
Who owns who and who owns what and why. All right, guys, favorite part of the show. Memo, you go first.
My favorite part of the show is that, again, I love our military. We come from a big military family, Yes. And so I'm here for them and with them. I'm just always trying to encourage them, like, buy something, plant your flag there in your home. So I'm just glad that they're getting these options, and we're not going to see a lot of homelessness because there's already a lot of homelessness with them.
Too much already.
And so let's keep them in their homes. Let's do everything we can for them.
Yeah.
And I'm cool with that.
I love that. Great. Brian?
I think for me, it was, although mortgage rates have been on the uptrend the last couple of weeks, mortgage applications came in higher than they have been in the last couple of weeks. So that shows a positive sign that people still want to buy regardless of the rate environment. And truly, like what I've been telling my people is that, the rates, the temporary issue, houses and inventory and inflation is really the big kicker. So,
good advice.
The rate's going to be able to get, brought down later down the line. So if you can afford the payment, you can negotiate some sort of help from the seller. Like, you can get creative enough right now to make it happen if you do have the right support, the right knowledge, and the right team behind you. But at the same time, it's not out of your reach if you, just play your cards right. But it's not for everybody, unfortunately, right now. Yeah. But the people that do have the right situation and can make it happen, you might be able to get away with a good deal.
No, good advice. You're right.
I have to break the rule today, guys. I actually have two favorite parts of the show.
Break it.
You being back on the show is awesome.
Let's go.
It has been several weeks, so I am glad you're back, and I'm glad that you made sure at the beginning we knew everyone also knew that you were back.
Yes, thank you.
He's back. He's back.
I am very grateful for the VA last resort option. I was sad when I saw that 185,000 people had to be helped last year. Yeah. I'm very grateful for that. I'm very thankful that help and that support was there, and the VA had to step in for 145,000 homeowners last year. The fact they're going to open up another 40,000 for this other program, even down the rung from other support programs they have for people, that brings a lot of gratification. Yeah. We do have a lot of family that have served in multiple generations of our family and in every part of the military, and it's really important to me that there are options available to them so that they are not left out on the street and they're not left out in the lurch, and that they can maintain the home that they use their VA benefit to buy. Yeah, no, so that's awesome. Hands down my favorite part of the show today. Yeah.
Again, it goes to our veterans. I play Xbox, guys, and so I'm gaming. I'm playing this PUBG. Couple of people that you start kind of getting acquainted with, so they'll come in and they'll play, and these randoms came in. We call them the randoms because we don't know them, but I hear them talking about they were in the military, and how their Humvee, how they were like, yeah, man, those 7.62s used to just, I hit them, used to just kind of fly by my ear, and we couldn't just go and shoot. We had to get permission to shoot back. And I'm just hearing these things, and I'm just like, whoa, bro. And I just kept my headphones just listening. I didn't want to say anything, just enjoying what their stories were. But some of these stories with the stuff that they go through is pretty freaking crazy.
Gnarly.
Man. Gnarly. Two of these guys, I mean, they're talking perfect, like English, everything. They did their time in the military. They live in Mexico. They can't afford it here right now.
Yeah.
They had to go somewhere else. They're like, hey, I'm going over here. I think I'm going to get better treatment or what have you. And so it's just crazy. So it was pretty cool, bro.
Nice. Wow.
Just cool to hear the stories. If you ever know, have a friend, military, anything, and you're not, just take the time to talk to them.
Yeah.
You'd be surprised, how much information these guys have, how much insight, and it is just awesome.
Yeah. Well, thank you guys for another great show, and thank you all for watching the Mortgage Heroes Weekly Podcast. Remember to subscribe to the channel, like this video, and also check out our other playlist called Friends of Mortgage Heroes, where Will, Brian, and myself interview our friends in and around real estate about success and failure, and how failure leads to success, and success breeds more success. We've had a lot of amazing shows that have come out recently. They're all so good. Man, some of our recent guests have just been so outstanding, and there's so many great nuggets of wisdom in there. So I really hope you all can enjoy that show, but also take something from that and apply it to your personal life so you can win in mortgage and real estate.
Yeah, and if you have any feedback, you guys want to listen to anything, please let us know. DM us. Let us know what you want to hear.
Yeah.
We're here for you.
Yeah, thank you so much, guys. I appreciate it. Thank you all for watching, and we'll see you again next week.
Bye, guys.
See ya.